the Digi based on the ratio analysis done for the year 2012 and 2013. So the two biggest companies when it comes to telecommunication in Malaysia is Digi and Maxsis. So let us have a brief introduction to their company. As you all know, Digi was founded in 1994 and listed as a public listed as it was listed in Bursa Malaysia in 1997. And it was the first company to operate cellular network and to first to offer GPRS service in Malaysia. And it has an 11 million customer base in Malaysia. Alright, our competitor is Maxsis, and they were founded in 1993, and it is a multinational company. They have 13 million customer base in Malaysia, and they have launched several satellites in Malaysia. So, to continue with our presentation, I would like to call upon Afras Hamid.
Thank you very much, Abdullah. I will be presenting on the profitability ratio. Profitability ratio basically it reflects the amount of profit a company can generate with regards to other factors, which I will mention later. The first ratio, okay, I should say that we were unable to calculate ROSF because the leader of the company has a preference share. ROCE, return on capital employed. If you can look at this graph, you can see that both Digi, which is in blue, for 2012 and 2030 exceed 100%. This is unusual, but it happens. It's not something common. And it happens for two main reasons. One is if the company has incurred losses in the past, and two, if the company depends more on debt financing. The second one is gross profit margin. Gross profit margin reflects the percentage of sales remaining after deducting the trade expense to cover all other expense. If you can see from 2012, which is in Digi in blue, to 2030, it reduced. This can happen for two main reasons. One is if the company reduces its selling price, and two, if the cost of goods increases. Even though Maxsis gross profit margin is less than Digi, Maxsis actual revenue, the amount of gross profit it generated, is more in terms of the actual figure. This can happen if the company sells at a lower price in order to attract more customers, as a result of which it increases its sales. The third one is net profit margin. If you can look, Digi is in blue, from 2012 to 2013 it increases. One reason for this is if the company in 2013 managed to reduce its operating expense, as a result of which its gross profit increased. That's all from me. I will call on my colleague Afras who will continue this presentation.
Myself, I'm looking at Mohammed Farooq.
Your student number is? 612.
Alright, I'm going to look into the liquidity ratio of Digi, and we'll be comparing with Maxsis. So what liquidity ratio means? The ability of the firm to repay their obligation with their existing current assets. So, alright, the current ratio for Digi and for the year 2012 is 0.52. It means that during the year 2012, Digi had only 52 cents of current assets for every 1 ringgit of liability they had. Alright, what is the main reason it would be is because this, when I look into their the figures in their financial report, that I could identify that they have more account receivable to pay, account payable than the current assets. This is the main reason. And in 2013 also it is the same. Whereas Maxsis, when I look into the Maxsis also, is remaining the same. They do have more account payables than current assets. Alright, asset test ratio is where the company's ability to pay their current liabilities excluding inventories. So basically, when it comes to telecommunication industry, we don't find much inventory in this industry. That is why we can see the difference between the current ratio and asset test ratio is there is no difference between them. Alright, the cash generated from operation is where this the ratio identifies the ability of the company to generate more money from operation to repay their liabilities, short-term liabilities. So you can see that in 2013, Digi had almost like 1.1 ringgit. I mean, like 1 ringgit and 1 cent, 10 cents for every ringgit of liability. It means that they could generate more cash from their operation to cover their short-term liabilities. And whereas the Maxsis also has been generating more money, I mean, in terms of to cover their short-term liabilities. That's all from me. Now I would like to call upon Mohammed Afras to continue with the presentation.
Your student number? 618.
Good afternoon, everyone. Thanks, Madam, my dear friends. I am Mohammed Afras. Let me quickly explain about the Digi Maxsis company efficiency ratio. First of all, what is the efficiency ratio? It says that how the company assets and liabilities used in order to generate the profit. Best ratio is the average stock turnover period. It says that how the company used the inventory in order to generate the profit. If you look at Digi company 2030, its average stock turnover period is 11.43 days. So it means that every 11 days the inventory is sold out in a year. When we compare it 2012, when you compare it 2012, it decreased in 2013 due to the higher sales. It may be higher sales. Also, if you compare with the Maxsis company, its Digi company is quite higher. The second ratio is average settlement periods for trade debtors. It says how the company use its debtors in order to generate the profit. If you look at 2013 Digi average settlement period for debtors, it's 17.04 days. It also says that the company debtors, they are averagely within how many days they settle their payment. If you compare with 2012, it increased in 2013 as well due to the late payment of trade debtors. It may be. If you compare with the Maxsis company, it's quite higher compared to the Digi company. The third is the average settlement period for creditors. Says how the company effectively manage their creditors in order to generate the profit. If you look at 2013, Digi company average settlement period for the creditors, it's 55.93 days. It says the average is 56 days they take to pay their settlement for the creditors. If you compare with 2012, it's significantly decreased in 2013, and compare with Maxsis, it's quite higher Maxsis creditors payment. The fourth ratio is that the sales revenue capital employed. It says how the company uses its employed capital in order to generate the profit. If you look 2013 Digi company, it's 5.11 times. It means that every 1 ringgit earns 5.11 times the revenue. When we compare with 2012, it's quite increased in 2013, and if you compare with 2000, Maxsis company 2013, there is, significantly decrease lower in Maxsis company. Okay, the last one, the sales revenue per employee. We said that all the company use their employees in order to generate the profit. If you look at 2013 Digi company, it's 2,974.12 ringgit. It says averagely employee earns 2,974.12 ringgit. But if you compare it to 2012, it's quite increase in 2013, and Maxsis sales revenue per employee is quite lower compared to the Digi company. That's all from me. Next place will be continued with us.
Thank you, Rehan. I'm Digi will be presenting for gearing ratio and interest, times interest and ratio. So for gearing ratio, as we know, we will see that how Digi's always Digi's contribution of the capital contribution of the we will see the gearing ratio, measures the contribution of the owners and outsiders to the company, and this ratio will be measures the long survival of the company. So if you see the gearing ratio of Digi in 2013 and we compare with 2012, as we can see that in 2012 the Digi's ratio, gearing ratio was higher. Notably, the gearing ratio, it's better that it should be lower, but now we can see that in 2013 Digi is able to do much more better, and also compared to the Maxsis, the Maxsis is doing little bit much more better than the Digi. So the reason why Digi has performed well in 2013, because of the reasons, the owner's capital, the owner has contributed more towards the business, and second reason we can give is their debt has decreased, and thirdly we can say that the net profit of the company was higher, and some has went to the distribution of the income, and the rest went to the retained earnings, and this has increased the value of the company. Now, if we see for the interest cover ratio, so the interest cover ratio says the Maxsis, how efficient the business is able to pay its interest expense on the outstanding debt. So here we can see that the comparing with the competitor and with the years of difference, we can see that Digi is performing very well in 2013, as we can see that it has able to pay 50 times more than in 2012. If we compare with the figures 30.8 and 50.3, it's been able to improve by 20.6 times. Thank you very much. I'll pass to my
Thank you very much, Asrina. Continue with the presentation. If you have decided to invest in one of these companies, either Digi or Maxsis, or even in other companies, remember these ratios. These are the golden ratios that you have to consider as an investor when you are deciding to buy stocks from companies. So let us go through some of the ratios. And the reason why I said these golden ratios, because investment ratios gives an bird view or a big picture of the company's return and the performance of the company. Okay. So the first ratio is dividend payout ratio. What do we mean by dividend payout ratio is that how much the company gives as dividend out of its earning to its shareholders. So in 2012, Digi decided to give 170% as dividends to its shareholders, and it decreased up to 97% in 2013. And its competitor, surprisingly and even coincidentally, decided to give the same percentage of dividend payout in 2013, where the Digi gave in 2012, which is 169%. The second ratio is dividend yield ratio. Dividend yield ratio is basically the percentage of the dividends paid out of its current market price. Let's say, for example, the current market price of Digi is 10 ringgit. If the yield ratio is 6%, this means that Digi pays 60 cents out of as dividend to its shareholders. This ratio is like, for example, if a bond pays 6% or 5% to its bond, that means a good stock has to be able to pay more than 6% or equal to 6% during the period of that time. Okay, the next ratio is the earnings per share. Earnings per share is basically after the company has paid dividends to its shareholders, the remaining amount which is there for the shareholders as earnings. So this is shown as percentage as in cents per share. In 2012, Digi had 15.5 cents as earnings per share for its shareholders, and it increased up to 21.9 cents in 2013. Compared to its competitor, it had slightly a bigger earnings in 2013, which is 23.53. Moving on, this is also a very crucial ratio, which is PE ratio or price earning ratio. Basically, what PE ratio means is how much an investor is prepared to pay to its stocks. Meaning to say that, for example, let's say the earnings per share of Digi is 50 cents, and the current market price is $10, 10 ringgit. That means the investor is prepared to pay 20 times of earnings of its share to its stocks. That means the higher the ratio, the better the company's performance. However, PE ratio, if compared singly, it may be misleading. So it has to be compared in the same industry between the competitors. Okay, moving on. Now let us see how during the 2 years of Digi, how the stock of Digi has performed. Although there was some fluctuation in the shares, it has somehow stably shown a growth rate which was from 4 ringgit up to 5 ringgit during the period of 2 years. And moving on to Maxsis, it also have showed a very good performance from 6.4 ringgit up to 7.2 ringgit. So now I would like to call Afraz to conclude the presentation.
Okay, thank you very much, Sajid. In conclusion, as a unit, we concluded that both companies are financially stable. However, Digi relied more on debt financing, whereas Maxsis relied more on its shareholders' equity financing. Our limitations, basically, our limitation, we had 4 limitations actually, but I'll just mention a few. The first one was we didn't have adequate information with regards to credit purchase and credit sales in the financial statement. So we had to refer to the lecture, and this causes some delay. The second one was we only used 2 years for the selected company and 1 year for the company to perform. This is not enough. The time frame is not enough in order to determine the company's performance. You need to have a time frame, a longer time frame. And the third one was that the financial statement only includes historical data. This may not give a proper prediction of the future performance. And last but not least, all the data we use were from the financial statements. The financial statements, however, doesn't include opportunity costs or risk associated with the firm. Our final word is that if you are an investor and you are a risk taker, then you can go for Digi. And if you are less riskier, then